Hi, I'm Diane Devani, broker owner of Pacific Ridge Real Estate.
And I'm John Cohen, president of Qualified Financial Incorporated, a local mortgage broker.
And this is the Weekly Five. How are you, John?
I'm doing wonderful. So,
Excellent.
so we took a little time gathering some ideas and what we're going to, or topics that we're going to go over in the next handful of weeks. And today I wanted to talk about the top three mortgage myths that are going, that roll, that kind of come out of people's mouths that are considering buying a home. So I want to debunk those myths. So the
Excellent.
the first one is some people think they need to put 20% down on a mortgage. So do the math. If it's like $1 million property, you have to come up with $200,000. So that is inaccurate. Okay. So there are a lot of different programs that are available. One in particular is just a conventional loan with as little as 10% down, sometimes even less. Okay. And you put less than 20% down, you're going to have some mortgage insurance, which is okay. But in other words, you do not have to come up with that much money for the down payment.
Right.
That's one option. Another option is a FHA loan that's insured by the Federal Housing Administration. And that's for people that have either less than perfect credit, don't have 20% down, and a handful of other reasons. They're a little more lenient on the guidelines. And with the FHA, they only require 3.5% down.
Right.
So do the math. If I use my calculator here, you're buying $1 million property, right?
Right.
And times 3.5%, you're talking about $35,000
Yep.
as a down payment as opposed to 200,000 to buy that property. The only difference is you put less down, you can get in the property. Your payment obviously will be a little bit higher because your loan amount's a little bit higher. And then, of course, for veterans, if you're a veteran, right, and you're whether you're in the military or no longer in the military, you qualify for 100% financing, no money down.
Right.
So these are just three different alternatives or options that are available to debunk the myth that you need to put 20% down. And
Right.
it's good to talk to a mortgage professional, someone who can go through the different options and payment options with you and ideas before you're considering buying to see if it's something that's even makes sense for you. So buying a home, especially being a first-time home buyer, or whether you're a first-time home buyer or not, um, it might be buying a home might be closer in reach than you actually think. Okay.
Absolutely.
So the other myth is credit scores. People think their credit needs to be perfect.
Hmm.
So the higher the credit score, the better rate that you qualify in most cases, right?
Sure. Sure.
So um, when you're doing a conventional loan, it's very FICO score driven. And conventional loans are usually people with high credit scores, 20% down. That's the normal circumstance. And they're very FICO score credit score sensitive, and they use three scores: Experian, TransUnion, and Equifax, and use the middle score is the one that they're going to use to qualify. So there are programs out there such as FHA with can go down as low as 580 on the credit score. Obviously, the higher the score, the better the rate. So in regards to that, I have a lot of clients that I work with that might have a score of 739 or 728. But I know if I can get them to 740, I'm going to get them a better rate with lower cost. And the way
Hmm.
I do that is I have a software that I use. It's called a what if simulator.
Hmm.
And or Wayfinder actually is what it's called. And I'll plug in the FICO score that I'm looking for that particular bureau, and it'll tell us exactly what needs to be done to improve that credit score. And it might be something as simple as remove yourself as an authorized user on your wife's card. It could be that simple.
Hmm.
Or pay down your Visa credit card by $320 and get a
Hmm.
copy of that new statement. And then we take that statement, send it into the credit company. We do a rapid rescore, and now you have better credit. So we 100% can improve your credit scores. Um,
Yeah, I've
and
seen you do it before. It's true.
yeah,
You're telling the truth.
yes, I do that for a lot of my clients, and they don't even know, like, they don't even know what's happened. I do it behind the scenes because I know that can I close a transaction quick without thinking about it and not have to say anything? Yes. But do I look out for my client's best interest and try to find them the lowest rate at the lowest cost? Because that is my goal.
Yeah,
And
you
the
do
way to
that.
do that is, what if I say, hey, pay down this by $320, send me the receipt. I'm going to improve your credit score. We just did that with one of the clients on one of your properties.
Right.
And it was incredible, the difference. And in that client's case, it was like $520 or $530 a month in savings.
Can you
And
believe
that was
that?
such a, yeah, it gave me the chills when we increased her scores and what it did for them.
Yeah, and she couldn't believe it.
No. And of course,
Yeah,
we got an incredible review from her. I'm very grateful.
yeah.
So,
You
and
were the
then,
hero again with another client.
oh, thank you. But it was, you got to do what's right for your clients. What's in their best interest, not yours. What would you do for your own family, your own kid, your own
Absolutely. Yeah,
respected grandmother?
yeah.
So, lastly, the last myth before we're running out of recording time here is a pre-qualification the same as a pre-approval? So there's a pre-qual and a pre-approval. So the answer is no, they're two different things. A pre-approval is you tell me on the phone what your credit score is, what you're looking to purchase and how much your income is. And then based on what you told me, you're pre-approved, right? So that's great. We want me to send you out a pre-approval letter, you can go out and shop. However, you're not pre-qualified. We don't know exactly. I never reviewed your credit report, never looked at it. That's the difference. One, with pre-qualifying, you're looking at the credit report. I'm reviewing the income. I'm reviewing the assets. I'm running through an automated underwriting software, and I'm now pre-qualifying the borrower. I will never send anybody out to go shop for a home with their hard-earned money, earnest money deposit in hand,
Right,
that they can potentially lose by based on what they told me. I'm going to always pre-qualify somebody, and then I will send them and their agent out with it's called a pre-approval letter, but they have been pre-qualified. So there
right.
is a big difference, and it does take, you have to rip the Band-Aid off. The credit has to be looked at. And a lot of times we could do a soft credit check in the beginning, and I'll explain how that works. But so yeah, those are the two differences. So just because you think you're being pre-approved doesn't mean you've been pre-qualified, and be very careful about that. Okay, so I think that's all the time we have, and
Great information. I like it. It's important.
it really is. So I appreciate everyone's time, and until next week, over and out. Take care.